In today's video, I'm going to be going over JPMorgan Equity Premium Income, or JEPI. This is a very popular ETF, especially among dividend investors. So I figured I'd cover it and basically explain through its documents how this fund operates and what it holds. I personally own this ETF. It is part of my dividend pie, which consists of 60% SCHD and 40% JEPI. Currently have about $10,000 invested, which is approximately 190 shares or so. And if you do enjoy content like this, please remember to like and subscribe for future content. So I did own this ETF for the past 3 months after I sold it for another Dividend ETF, SPHD. That ETF also pays monthly like JEPI, but I thought for quality purposes, JEPI was the better ETF. And I made a video a few weeks ago explaining why I switched, but this video is going to go over JEPI a little bit more in depth than the other video. So definitely stay along and watch, because this video is going to get into the finer details and maybe why you might want to invest in this dividend ETF versus other ETFs that pay dividends. So as I was saying, this ETF pays monthly. It pays around the first week of every single month consistently. And the dividend does vary from month to month. And I am going to be getting into why there's a variation between month to month. But the important thing to take away right now is that this dividend does have an objective of paying monthly, and it does have an objective of paying a high yield. So before I actually get into the holdings, I'm going to give you a brief overview of how this fund operates. This is from the page itself, and this is kind of just a brief overview. So a defensive equity portfolio employs a time-tested bottom-up fundamental research process with stock selection based on our proprietary risk-adjusted stock rankings. And disciplined options override implements written out-of-the-money S&P 500 call options to generate and distribute monthly income. So again, it distributes dividends every single month. So before I get into how that dividend operates, I'm going to focus on the stock selection process and how they select stocks. And to do that, first I'm going to give you a brief overview of the top 10 holdings. So this top 10, and in fact the entire portfolio that they select, is very diversified based on industry. You're going to basically see every single industry in here. You're going to see anything from tech like Microsoft to things like healthcare like United Healthcare. You're also going to see holdings that you generally wouldn't expect, like Progressive or Accenture. Those really aren't holdings many people focus on. Now, the percent of assets, they basically keep it mostly the same, especially for the top. There really isn't much variation between the top holding and the bottom 10th holding. There's only about 0.2%. So overall, it's kind of equal weighted, especially toward the top. And the objective here is to basically invest in a diversified number of stocks within different industries. Now, why does this portfolio, this fund, hold the stocks that it holds? So it constructs a diversified, low volatility equity portfolio through a proprietary research process designed to identify over and undervalued stocks with attractive risk return characteristics. So it also holds all large caps, so these are going to be large companies. Now, the important thing to take away from this are not only its diversification and large companies, but it's also selecting stocks with low volatility. So basically the intent of this portfolio is to not only pay dividends, but also give the underlying fund, its holdings, have low volatility. So you don't want this fund to basically move very much and pay dividends. So it seeks to deliver a significant portion of the returns associated with the S&P 500 index with less volatility, in addition to monthly income. So it wants to have basically the same return of the S&P 500 with less volatility and also monthly income. And this is going to be with dividends reinvested. So from this fund literature page, this is a little bit more in depth, and it goes about how it selects and how this fund kind of adds together. So defensive equity portfolio, again, leverages time-tested 30-year plus investment philosophy and process to solve for lower beta, lower volatility. So again, its stocks that it selects are for low volatility. And then there's options overlay, 1 month out of the money call options designed to generate income and give investors a portion of the upside with reduced volatility. Now, I'm going to get into how those options actually work in this portfolio because it's not exactly as clear as selling a covered call on the S&P 500. But what this gives you is a well-diversified strategy designed to have the daily liquidity and lower volatility and beta of the S&P 500. So again, it kind of does a blend of income and dividend stocks to basically pay dividends and also income. So this is how this breaks down. For about 1 to 2% of the income that you receive from this portfolio, you're going to be getting that from dividends that the fund holds. So the majority of the income you're going to be receiving is from options premium, of course, about 5 to 8%, which is going to be the bulk of that is going to be options premium. And now, as I showed you before that monthly dividend, the reason why your income changes month to month is because higher volatility environments have allowed for more potential options premium. So basically, the way options work, especially on the sell side, is when there is more volatility, that options premium expands. And I'm not going to get too in-depth into how these options work because that's not the intent of this video. Just the key takeaway from this is more volatile environments will increase the income of this portfolio because of options. And we see down here how this works over time. You see that, again, majority of the income did come from options, and you have a lower amount in blue here that came from dividends. So again, it changes month to month, which is why you're going to be seeing a smaller portion come from options premium because a lot of these months there were reduced volatility and therefore your options premium decrease, which decreases the premium for the entire portfolio. So now I'm going to get into the truth about how this fund basically gets that options income. It's not as simple as selling covered calls as other videos you've watched may have mentioned, or if you're new, you'll basically find out that this ETF can't sell covered calls on the S&P 500 because the underlying assets it holds isn't the S&P 500. In a typical sense, you would see a fund like QYLG, or actually rather like XYLG, that actually does hold the underlying asset, whether it be the NASDAQ or the S&P 500, and then they're able to sell covered calls on that. In JEPI's case, since it doesn't hold the S&P 500, it has to use something called an equity link note, and you see it as actually part of the portfolio holdings. So this is the entire holdings list here, just as basically a crude spreadsheet. And you'll see it's a synthetic asset in an equity link note. And basically what an equity link note is a debt obligation that's linked to the performance of another asset. So in this case, these equity linked notes are linked to the S&P/X, or the S&P 500. So these notes, these debt obligations, are going to be linked to the performance of the S&P 500 with a covered call 1 month out against them. So you're going to be getting that income not as strictly a covered call, how a covered call would conventionally work, but rather as a payout from the performance of this debt obligation of an S&P 500 covered call option 1 month out. So it's a little bit convoluted, but basically the way it boils down to is that it's not a conventional covered call. It's just a debt obligation that mimics the performance of the S&P 500 having a covered call on it. So it's kind of a nuance, slightly different. And if you are really risk adverse, you might want to question this because there's going to be a counterparty risk if the issuer of this goes bunk, but they probably won't at the end of the day. And you likely will get the income associated with this with limited risk, but they do have to put that in there because of course it is a risk and they have to disclose that. So while we're in here, I'm kind of just going to scroll down to give you viewers a brief overview of the portfolio in its entirety. I'm not going to go through the entire thing here, but I am going to probably go over around 50. I'm not going to speak about them. I'm just going to scroll down so you can view. I kind of just want to give you all an idea of the constitution of this portfolio, what constitutes it. It is basically, again, very diverse, and all these holdings here are selected to reduce volatility, and they're all approximately equal weighted. Again, we see those equity linked notes, and basically the idea is this is just a well-diversified portfolio with lower volatility, and we see pretty much every single industry there is. So now I'm going to get into the performance of this fund. It hasn't been around that long, only from around January of 2021. So I am going to be running something through Portfolio Visualizer. What I did was I invested $10,000, reinvesting those dividends, of course, and we're going to see how that performed against the S&P 500 and see if it matched its goal. And I think you see here that it did pretty well in matching the goal. Its performance was pretty much right in line with slight variation. You're basically missing out on $100 here. And again, its goal, remember, was to match the returns of the S&P 500 with dividends reinvested with reduced volatility. And I think you can see by looking at this, it did very well with its goal. Again, it pretty much matched the performance of the S&P 500. The standard deviation is lower. It had a lower worst year, a lower max drawdown, and of course a lower best year because its volatility is of course lower, and it invests in a little bit of different assets than the S&P 500. But it performed pretty much right in line with what it was supposed to do. Now, the true story of how this fund will probably perform over time, though, again, because there's limited history for it, there is another fund. It is a mutual fund version of JEPI, and it is JEPIX. That fund has been around for about 2 years longer than JEPI, so a little bit more history, and we do see this fund actually, unfortunately, lag behind the S&P 500 by a good number, and it did have, again, a lower volatility than the S&P 500, so it performed well on that metric. It did have a lower worst year and a lower max drawdown. But again, it did not perform in line, so it didn't really do that all too well. But again, its lower volatility definitely came into play. So investors not needing to worry about volatility or not wanting to worry about volatility might be a good idea to invest into JEPI. Now, I do want to show you all the actual performance based on dividends. Now, if you're a dividend investor, odds are your benchmark probably isn't going to be the S&P 500 because everybody pretty much knows that there's going to be some variation between the S&P 500 and dividend paying stocks, a dividend paying portfolio. So perhaps the best benchmark isn't the S&P 500, it's other popular dividend ETFs. So that's kind of what I want to show you actually, because as a dividend investor, you're going to be wanting to see how it matches up against other dividend ETFs and not necessarily the S&P 500, and to give it a little bit more of time, I am going to be using the mutual fund version of this ETF instead, because I want to basically give you a more historical idea of how this fund performed. So instead of the S&P 500, I use it as a benchmark, instead the Vanguard High Dividend Yield ETF. So pretty much if you're investing in JEPI, you obviously want a high dividend, and there's another dividend ETF, Vanguard High Dividend Yield, that invests more in a conventional way, and it's also very popular in its own right. And we do see that JEPI does beat out this ETF, and it has a lower standard deviation than VYM itself. So it not only beat out the very popular dividend ETF, VYM, but it also did it with less volatility, and again, it does pay a higher dividend. So it beat that ETF out pretty handedly. But maybe you're a monthly dividend investor like I buy this ETF for. I like the idea of a monthly dividend because it basically kind of simulates a basic like month-to-month paycheck, kind of like Social Security, even though I am definitely not at that age range. I buy this ETF more so for volatility reduction purposes, but I changed this ETF. I bought this ETF instead of SPHD. I sold SPHD, and I'm going to show you why I sold SPHD here, how it performed versus JEPI. And we see that this monthly payer, which is also a pretty popular monthly dividend ETF, its objective is to pay high dividends but every single month. And JEPI, or the mutual fund variation of it, just destroyed this ETF. So its performance was much better. It had lower volatility and it had a lower max drawdown. had a lower worst year. So I think it kind of is a no-brainer why I sold SPHD and bought JEPI, because the way JEPI operates, first, its underlying stocks it holds are far superior against the holdings that SPHD holds, and it also pays a higher dividend with low volatility. So why would I want to hold SPHD when JEPI would obviously perform better over time? I really wouldn't. And for volatility purposes, for gains purposes, and for monthly income, JEPI definitely is far superior to this other common ETF. So basically beat out both VYM and SPHD, which are both high dividend paying ETFs, quite significantly. So again, that's two ETFs that it beat out. Let's just see one more. So another ETF a lot of people buy into instead of SPHD is going to be SPYD, and that is a spider high dividend ETF, and that pays quarterly, so a little bit different. Again, it's more like VYM instead of SPHD. But we see that JEPI, of course, outperformed this as well. So it performed it not only in gains, but also, again, had lower volatility, far lower volatility, and it also had a lower worst year, again, lower max drawdown. So it basically beat out these three very common and very purchased ETFs among dividend investors year over year, and it did it with, again, lower volatility than those other ETFs hold. So I think it's pretty clear that if you're looking to buy a dividend ETF, I think a lot of people shy away from JEPI or the mutual fund version of it because they might worry about its underperformance over time. But with these dividends reinvested and going toe-to-toe with these other very popular ETFs, I think it's pretty clear that JEPI does perform in line or actually better than most of the other dividend payers that are very popular. Again, it doesn't really perform necessarily as good as the S&P 500 over time, but as a dividend investor, that's really not your benchmark. But maybe you're like me and you want to switch it up a bit. So like I said before, I kind of do hold SCHD along with JEPI as a 60-40 split, with SCHD being the bigger fund. It is a little bit more conventional, actually far more conventional than JEPI, because it is basically a standard dividend ETF that further filters its holdings through financial ratios. But I just want to basically compare my dividend portfolio with several other ETFs that pay dividends too, and show you how that performed, and maybe you'll get an idea of how well this portfolio basically performs, how it's constructed. So before I get into the performance, I do want to say, based on the selection criteria of both these ETFs, there's going to be very little holding overlap. So there's a lot of diversification between these two ETFs. If you look at them side by side, they do have some overlap, but because of the way JEPI is constructed, there's really not that many holdings that are comparable to SCHD. And the holdings that are compared, or the holdings that it does hold that are also in SCHD, there is very limited overlap because of the percentage weighting that JEPI weights them in its portfolio. So very diversified when you hold these two together overall. So the first ETF I am going to compare this to is kind of not even a high dividend paying ETF, and I think that I want to do this to kind of show you the power of my portfolio against even dividend growth ETFs. So we have DGROW here, and again, I'm using the mutual fund version of JEPI because it has just a longer history, and I want to show you guys over time. And DGROW is the iShares Core Dividend Growth ETF, so it's basically more so a dividend growth ETF than necessarily a yield ETF. And you'll see that my portfolio basically performed in line with this dividend growth ETF. And it also had a lower standard deviation, a lower max drawdown, and a lower worst year. So not only did it basically perform in line with this extremely popular dividend growth ETF, but it also did so with lower volatility and also paying a higher dividend and also paying a dividend monthly. So now I'm going to compare it against another popular dividend ETF, a dividend growth ETF. I actually hold this ETF too. It is the Vanguard Dividend Appreciation ETF, And we see that my portfolio did underperform this ETF too by a little bit. But again, a lower standard deviation, a lower worst year, and a lower max drawdown by a little bit. But I think that the thing that people should really take away from this is that this portfolio is now going up against growth ETFs that are dividend growth ETFs actually. So it's performing in line with these dividend ETFs that have a completely different investment methodology, while it's paying out a huge dividend and it's also paying out monthly. So I think the way my 60-40 split works is definitely a great contender for a great portfolio versus even dividend appreciation ETFs. So finally, I am going to just show you against the VYM how this performed, and it just clearly just outperformed it by a lot. So a good amount of returns more, and again, that's going to compound over time and a better standard deviation. It had a higher worst year, but a lower max drawdown. So I guess 1 year just didn't perform very well, but it also had a lower max drawdown with lower volatility. So I kind of want to give you the takeaway here that if you are a dividend investor and you want high dividends monthly, a 60-40 split between SCHD and JEPI, like what I do, might not be a bad idea. I kind of just want to give you some consideration to this investment methodology that I use, because I think it clearly outperformed many other common conventional or popular dividend ETFs in high yield dividend ETFs that people invest in. And again, this isn't a very long history. It's only 4 years. But in that 4 years of time, we just see complete outperformance that this portfolio did. So that's going to be it for today. I do hope you all took some insight away from this video. Maybe you were an investor in JEPI to begin with, or maybe you're looking to invest in it and just had questions about it, or maybe you wanted to look for other ETFs that complement it, like SCHD, like my portfolio, how I invest in it. And please remember, if you do enjoy content like this, or if you like this video, definitely please like and subscribe for future content. And I want to again thank you all for watching. I greatly appreciate it, and all have a good day.